Welcome to another episode, listeners. Today we are having a little bit of a special episode. We're speaking about the budget that was introduced just last night. But before we get into that, Sean, I haven't seen you in a while on this podcast. How you been?
Are you still the same
Yeah,
age?
you're looking good, looking dapper.
Thank you. Appreciate that.
So, Amy and Sean, you guys wanted to record something a little bit on the short end about the budget, highlight some important points that you guys thought are most crucial to investors, to our clients and others.
Well,
What do you have for us?
We felt what could be more interesting than a public cast on a budget. So we felt this was the time.
Good one.
This is the time for me to make a special appearance.
Let's go for it.
Here we go.
Sean loves paying taxes.
Number one, what do you got for us, Sean? Let's hear
Well,
it.
as we know, the federal budget was passed it was proposed yesterday. Has not been passed in the legislation.
Yeah, that's important, right? So these are just proposals, and then it has to go through the next step of
covered a number of items from a spending and taxation perspective, ranging from capital gains inclusion rates for corporations, trusts, and for individual persons. Talked about increases to the lifetime capital gains exemption for qualified Canadian businesses. There are some disability and CPP provisions inside the budget. It also proposed were some initiatives are centered around housing affordability. Mm-hmm. I thought maybe today we could talk about two that, at least from an initial perspective, probably have the most immediate impact on our clients and perhaps those who are listening.
And we'll
to our
post
podcast.
the summary just that National Bank came out with. We'll post
Absolutely.
that, but we figured just to highlight a couple of the key ones.
Yeah. Yep. So I think the one that's getting the most attention, and by the way, from an overarching what we were hearing may happen, this is not the worst thing ever.
Yeah, the amount of calls we were having with accountants and clients just on hypotheticals, it was getting me all worked up about I'm like, oh no, what's going to happen? So it was, I think our expectations were at a certain level.
It's almost like a form of Stockholm syndrome, right? It's like it comes out way better than we thought, even though we didn't know how bad it could have been. We'd be like, what the heck's going on? But anyway, I digress. This is not meant to be a political commentary.
Love it.
No.
But what we thought we'd talk about is the capital gain inclusion rates, which is proposed to be changed effective June 25th, 2024.
Correct.
And it's a reasonably simple change. The capital gains inclusion rate right now as it stands is if you realize a capital gain of $1, 50 cents of that is included in the calculation of your taxable income.
Correct.
And what the federal government is proposing is that for amounts, this is for individuals, not for corporations or trusts. Corporations and trusts are different. But for individuals, what they're proposing is that the capital gains inclusion rate increases from 50% to 66%. For that amount of capital gains, you realize in any given year commencing June 25th, 2024, in excess of $250,000.
Mm-hmm.
Put it in my terms, Sean. What does that mean?
Well,
Make me understand it.
you're going to pay a whole lot more tax, Jalal. That's what it means. So no, actually, what it means is basically
So somebody sold assets in post June 25th. Let's just say August sold assets, and he has $350,000 in capital gains.
Mm-hmm. So what happens is the first $250,000 would be taxed at the original inclusion rate, which is 50%, and then the increment over, which is $100,000. That actually is taxed where the inclusion rate is 66%.
Yes.
So 66% of the $100,000. So $66,000 will be, in taxes, pretty much.
Yes.
Okay. All right.
That's going to be added to your taxable income. When normally it would have been 50%.
Yeah.
Right, 50,000.
Okay. But the important thing here to note is the June 25th effective date.
Right. So for individuals, where does that come into play? So for most taxable portfolios under $10 million, you can do a pretty good job managing capital gains exposure, especially given that, to our understanding, again, subject to approval, parliamentary approval, and also some professional tax advice, which we always encourage you to seek in these matters.
Yeah.
Each individual has a $250,000 capital gain threshold. So if you have a $10 million investment account, which we all wish we hopefully do one day, if you don't already, if you're married, each spouse is entitled to $250,000 of capital gains, assuming the account's jointly held, before you accrue the extra inclusion rate to 66%. Now, if you have your money held in a corporation, like a holdco or something of that nature, or your money's held in a trust, it's a little bit different. What they're saying is effective June 25th, all capital gains you accrue from $1 is subject to the 66% inclusion rate rather than what was former, which is the 50% inclusion
So in your
rate.
same scenario, that 350,000 gain is all going to be taxed at that 66.67%, not to 50. So it's the full amount.
So if you have money invested inside a trust scenario, if you have money invested in a corporate scenario, you do have some time-sensitive decisions you need to make in order to determine where you're better off realizing a capital gain, should you have to, and we'll get into that in a moment, whether it's better to realize the capital gain earlier than June 25th, or do you just wait till June 25th passes and subject yourself to the normal regular capital gain rate.
But where we can see this cropping up for a lot of clients is on their secondary properties, whether it be the cottage property, vacation home, rental properties, things of that nature. That's usually where you're going to get that big capital gain when you go to sell that. So that's something from a planning perspective is we need to be a lot more mindful of.
Yeah, I mean, if you picture, there's a lot of families that have their cottages or their leisure properties that have been in their families for years and years and years.
Yeah.
The capital gains can be quite excessive. And as we know, secondary properties are taxed upon the death of the surviving spouse or on the death of the surviving individual. The capital gain is taxed at the prevailing capital gains rate within your estate, and then it's dispersed to your beneficiaries. So things have changed on that front, because I doubt, and I would never encourage someone to rush out and panic sell your cottage prior to June 25th, 2024. But it also applies to people that own rental properties or investment properties or commercial buildings and things of that nature, where you've owned it for a while and you've built up a capital gain. Because again, when you're managing a diversified portfolio, there's things we can realize capital losses within the year. We can trim over the year. We can continue to unrealized gains, which, by the way, is still one of the best tax deferral mechanisms out there, is an unrealized capital gain. You can just own the asset and let it accrue for you.
Meaning you just don't sell, right? You just hold on to it,
It's a great tax deferral mechanism. It's really unheralded. No one really talks about it, but it's something very powerful.
Right.
But if you need to realize a capital gain, it's going to be those larger assets you hold in your portfolio where you have limited ability to offset that gain with other deductions.
Yeah.
Well, no comment. What was the second thing?
We have to
give
keep
me,
it
give me
positive.
Give me some happy news.
Well, there's a little bit of happy news.
Let's hear it.
Well, if you look at the lifetime capital gains exemption for qualified Canadian businesses, they're increasing that to $1,250,000 per person. And I believe that is up to like 6 family members. Again, it's very new. We're just hours into it, but that's better. And I think they've also added some provisions around household affordability. I think, Amy, you were going to talk about the
the home buyers plan. A lot of clients come to us when they're either their kids or themselves are buying their first home. The first time home buyers plan used to allow you to take up to $35,000 out of your RSP for the purpose of buying that first home, and then you had to pay it back. Over the next 15 years, you had to put it back. They're now going to increase that you can take out $60,000 out of the RSP, and they're proposing that you don't have to pay it back in the first 5 years, and then it'll be 15 years after that. So they've kind of come out with that. So to help people,
but that should help with some people trying to put a down payment on for sure.
But I think one of the key messages I want to put out there is that this is not a budget. I think you and I were talking about Jalal prior to us going on air that you need to run around with your hair on fire.
This is not a budget that you need to run around?
No, there's nothing urgent where there's, that you need to be pressured into making a quick decision. What I would strongly recommend is consult your investment people and consult your accounting people, especially if you have an asset with a ballooning capital gain in it that you are looking to sell in the next 18 months.
Well, there are strategies, right? And we won't get into a lot of them today, but insurance can be a tool to help mitigate some of these things. So it's going through the proper planning when these things are eventually passed and figuring out what is it that we might be able to do.
And you got to do the math.
Yeah.
Basically understand what your exposure is. Yeah. And then make a decision accordingly.
I feel like I'm still running around with my hair on fire. I just hate I don't like change, and when taxes, it's just, I know. It's just part of the way.
This is not one of these podcasts, Amy.
I know.
You've got to keep your emotions in check.
Bury it down.
Happy place, everybody. Anyway, that's what I wanted to leave listeners with and viewers is that, consult your accountant.
Yes.
Be calm. Things are okay. And always, look, this is a feeble type of comment in this situation, but it rings true. Is that if you're paying a capital gain, it's because you made money. And I think, I did some math last night. Even with the higher inclusion rate, receiving income as a capital gain is still the most tax efficient means of receiving income in Canada. That and a qualified Canadian dividend.
Right.
It ties now. It used to be capital gains were the most efficient way to receive income in Canada.
Yeah.
But it's still a lot better than earning income and having the marginal tax on that.
Right. Right.
So it's not a complete disaster. It's not great. No one likes to pay new taxes, but
No.
it's a manageable
Sean
situation.
always has a balanced way of
There you
looking
guys
at
have it.
things. There you go.
Budget 2024.
Budget 2024. We will post the full summary in the link, but just wanted to jump on and give you a few highlights. So till next time.
Thanks, everybody. Thanks for listening.